Um, Good afternoon, everyone. I appreciate you joining us for the webinar on property tax deductions and credits. My name is Stephen Lucas. I am joined today by my colleague, David Marusars, and we are happy to be presenting on this topic to you. I'm going to give our normal disclaimer that our department typically gives ahead of presentations. The slides that we're presenting and the information we're going over today is not a substitute for reading the Indiana Code, which always governs. This is not meant to be legal advice, just an informative presentation, which we hope you will find helpful. I wanted to mention this especially this year, given the large number of changes made to property taxes generally, but especially to the deductions and credits that we're going to be going over. Our presentations can get out of date fairly quickly if there are additional legislative changes. So just be mindful that this information is presented as of today, and if there are changes to the law, that will obviously impact how accurate this information is. With all that said, if you are not sure about something, don't hesitate to reach out to the department and ask questions. We always do our best to answer those questions, or if we can't for whatever reason, we attempt to direct you to the appropriate resource. So with that disclaimer out of the way, this is this afternoon's agenda. There are several topics we're going to try to get through, so we're going to move fairly quickly. As Jenny mentioned, if you have questions, drop those in the Q&A chat box, and we will get to them as we can. So after going over some of the background basics and definitions related to deductions and credits, we will get into the specific requirements that apply to some of the most common property tax benefits, including the blind and disabled credit, the over 65 credit, and the over 65 circuit breaker credit, deductions for veterans, homestead deductions, both the standard and supplemental, deductions that trust-owned properties are eligible for, the Heritage Barn deduction, and then a quick summary of some of the new deductions and credits that are recently enacted, along with the recently expired deductions from the 2025 session. So with that, I'm going to dive into some of the basic background information and definitions that often go overlooked. I know taxpayers certainly that reach out to the department don't always distinguish between deductions, exemptions, and credits. They use those terms interchangeably, so I thought it would be useful to just briefly remind everyone of those differences between the different property tax benefits. You may already know this, but a deduction is a reduction in the assessed value of the property being taxed. It's a reduction of that gross assessed value, as opposed to an exemption, which either in part or in full exempts that property from being assessed and or taxed to begin with. We also have credits, and that is a reduction in the property tax liability, which is something you arrive at after you get your certified net assessed value and then take that multiplied by your tax rate. So they're all different, although they all end up being a tax break for the property owner. On this slide, we've listed some examples of each of those benefits. You'll likely recognize many of these. An exemption, as I mentioned, is applicable to property that is not taxable at all, and that can be either a partial exemption or a full exemption, depending on how the property is used. But we most commonly see this with religious organizations or charitable organizations, and those are largely covered in Indiana Code 6 1.110, although there are other exemption statutes that can apply. Deductions, again, on the other hand, are a reduction in the taxable assessed value of property by a certain dollar amount. Now, that certain dollar amount can be a flat amount that statute specifies. We see that with the deductions for disabled veterans and now for the standard homestead. It can also be a percentage of the AV that yields a certain dollar amount when multiplied by the assessed value. We see that with the supplemental homestead deduction. So we'll get into some of those details later on. But many of the deductions that we're going over, those are housed in Indiana Code 6 1.1-12. Finally, again, a credit is a reduction in the tax bill or the tax liability by either a designated dollar amount or percentage, or in some cases, it may be a cap that prevents the tax bill from exceeding a certain threshold. We see that with certainly the statutory tax caps, the over 65 circuit breaker, but we'll be going over some of the new, well, converted deductions, such as the over 65 and blind or disabled deductions that are now just flat dollar amounts that apply as credits. This slide is largely redundant, so I'm going to move on to this example we've put together to show you how we look at deductions. In this example, we have a property that's assessed at $200,000. It's a homestead, so it is eligible for both the standard homestead deduction and the supplemental homestead deduction. You see that for pay 2026, the standard homestead deduction amount is $48,000. So we subtract that from $200,000, that leaves $152,000, which we then multiply by the amount of the supplemental homestead deduction, which for the current 2025 pay 2026 is 40%. So that's how we get that $60,800. And finally, in this example, we have a deduction for a disabled veteran. So here we have a deduction for $24,960. So those three deduction amounts are subtracted off of the gross assessed value. After you subtract those, you're left with the net assessed value, which is the amount that would be multiplied by the property tax rate. So here, just a note about the veterans deduction. We suggest that that's applied last so that if there's any unused portion remaining, other deductions, for example, might bring the assessed value down to zero. If any of that veterans deduction remains, it can be applied. The veteran can use that to seek an excise tax credit, which we'll speak about in a short while. Just a note here that the homestead donated to a veteran, the deduction for a homestead donated to a veteran can be applied in any order. We'll cover that a bit later. And as I just alluded to, it is possible for deductions to zero out a tax bill. If the value of the property is low enough that happens, that's okay. There is an exception to that for mobile homes assessed as personal property. Indiana Code 6 1.112-40.5 specifies that the sum of the deductions that apply to those personal property mobile homes can't exceed 50% of the value of the mobile home. There is an exception to that exception that says that the supplemental homestead deduction doesn't apply, isn't subject to that limit. So the supplemental homestead deduction may bring the value of those personal property mobile homes below that 50% threshold. By and large, deduction applications, credit applications must be filled out, signed, and filed or postmarked by January 15th of the pay year. So for pay 2026 taxes, those would be due January 15th, 2026. We'll mention later in the presentation, heritage barn deductions have a slightly different deadline, but most of the benefits we are talking about today have that January 15th deadline. I also wanted to mention very quickly here how these deductions are to be applied and in what order. There is a statute here that I'm displaying that says if a deduction is specific to an improvement, that deduction is applied only to the assessed value allocated to that improvement. So we'll see that with the heritage barn. Obviously, a homestead deduction applies to the homestead property. But here you see in subsection B that if the deduction or exemption amount is not specific to an improvement, it should be applied to the assessed value in the order that will maximize the benefit of the deduction or exemption to the taxpayer. So that's a maxim we often tell folks. If statute doesn't specify how something is to be applied, the fallback position is applied in the way that will maximize the benefit to the taxpayer. And here we've got a table that shows several different property tax benefits and the order that they should be applied. Here we would start with exemptions. As I mentioned, those mean that the property isn't subject to tax to begin with, so it makes sense that you would apply those first, followed by deductions. And as I just mentioned, the order of the deductions can be specified by statute or can be specific to an improvement, but to the extent that it's not spelled out, it should be applied in the order that maximizes the benefit to the taxpayer. Many of the credits that we're going to go over do have specific rules about when and how they're to be applied. So the order listed here is meant to be a helpful reference. And we've also included, to the extent that folks are interested, whether debt taken out or referendum proceeds are protected or exempt from the application of each of these benefits. So I also wanted to note some just high-level similarities between deductions and exemptions. We're not going to go over the details of exemptions, but just to distinguish the two. In both cases, they are treated sort of like a government expense because in our case, local governments are foregoing a certain amount of revenue that they would have collected otherwise were it not for these benefits. So it's in many cases treated like a government expense, but they're meant to provide relief to property owners either based on certain characteristics of the property or of the property owners themselves. They do shift the tax burden to other taxpayers, and so whether to have deductions, credits, and which benefits to provide, that's a policy call made by the legislature. Some of the ways they differ, deductions and exemptions. Deductions are typically filed with and approved by the county auditor. It's the county auditor who receives those applications and makes a determination as to whether the particular applicant qualifies, meets the requirements, and approves those benefits. Contrast that with exemptions. Those are filed with the county assessor, and those are subject to approval by the county PDBOA. As I mentioned, there's a policy aspect here. Deductions can be geared towards providing relief to a certain class of taxpayers that the legislature, for whatever reason, believes should receive some sort of property tax relief. That could be because they are especially burdened and would not be able to afford property taxes otherwise, or property owners who have certain improvements the legislature should be encouraged or taxed more or less. So it's a policy call. And that's similar to exemptions, although with exemptions, we see typically those are geared towards organizations, entities that are reducing the burden that would otherwise be placed on government. That's because the charitable organizations, the religious organizations, these other entities that are often exempt from property taxes are providing some sort of service to the community that then reduces the burden placed on the unit of government. And we've got several examples here listed on the slide. But just a quick note again, even though these are similar in many aspects, deductions and exemptions are not the same, and we hear folks sort of mix up those terms all the time. So I just wanted to go over that. I mentioned too that many of the property tax benefits, whether it's a deduction or a credit, are based either on the characteristics of the property or the characteristics of the taxpayer or the applicant. Now, I've got several of the property tax benefits listed here that are commonly used, although many of these you'll see have started to be eliminated from state law for various reasons. You see the mortgage deduction that was eliminated a few years ago. Just this past session, there were several environmental deductions that were eliminated. The fertilizer storage deduction was eliminated. So it'll be interesting to see whether we continue to see a shift away from these sort of carve-outs, deductions based on the characteristics of the property, and whether the legislature continues to move in that direction. But many of the benefits we're going to go over are based on characteristics of the taxpayer, in addition to the remaining deductions up above under characteristics of the property. So with that, I will dive into our first benefit, the blind or disabled credit. Now, this benefit was up until this most recent legislative session. This was a deduction. It has been converted to a credit. It is now a credit of $125 that applies against local property liability if the applicant meets the qualifications in the statute. And those qualifications are the taxpayer or the applicant is either blind or has a disability. The property owner has to use and occupy the property as their residence, and they have to own or be buying the property under contract on the date that they apply for the benefit. The deadline to apply for the benefit, again, is January 15th of the year that the property taxes are due and payable. Now, the definitions for blindness and disability are spelled out in the credit statute. The definition for blindness is actually made by reference to another section of code, well, another title entirely. So I've listed that citation here. The definition for disability is spelled out in the credit statute, and that is an individual who is unable to engage in any substantial gainful activity by reason of a medically determinable physical or mental impairment, which can be expected to result in death, or has lasted or can be expected to last for a continuous period of not less than 12 months. So with either an applicant who is blind or disabled, they have to provide proof of their eligibility. For applicants who are disabled, the statutes I've listed here, the subsections E and F, speak to what can be provided as proof. That's proof that the applicant is eligible to receive disability benefits under the Social Security Act. That suffices. However, that's not required. An individual who is not covered under the Social Security Act, who's receiving disability benefits, can still be examined at their own expense by a physician using the same standards that Social Security uses to determine disability. So that would be on the applicant to go and do, and then provide proof of that disability to the auditor. Showing proof of blindness is a little less clear than it was under the previous deduction statute. Previously, the deduction statute specified that an applicant who was blind could provide support for that by showing records of the Division of Family Resources or the Division of Disability or Rehabilitative Services, or a written statement of a physician or optometrist licensed in Indiana and skilled in the diseases of the eye. So those standards for providing proof were included in the deduction statute. They were not carried over to the credit statute, although certainly if an applicant can provide either of those, that would be sufficient. However, I read the credit statute to mean that that's not the only proof that could be provided. So again, it's the auditor that makes the determination about an applicant's eligibility. If the auditor isn't satisfied with the documentation the applicant has provided, you can always ask for more information. It's on the applicant to provide that proof that shows that they qualify for the credit. So I wanted to note briefly a couple of differences between the old blind and disabled deduction and now the new credit. One of the big differences is that the income limitation that previously applied to the deduction, that was not carried over to the credit. So an applicant who was applying for the deduction couldn't have an income that exceeded $17,000. That income limitation is not present in the credit statute, so there is no income limitation for someone applying for this blind or disabled credit. Another difference is that the blind and disabled credit is not a deduction. So I talked about the differences between those benefits. It also matters because that limit that I mentioned that applies to the sum of deductions on personal property mobile homes and how those can't exceed half the value of the property, that applies to deductions. So by virtue of this property tax benefit now being a credit, it is not subject to that general limit on deductions placed on mobile or manufactured homes. I am now going to move into the over 65 credits and the over 65 circuit breaker credit, which are similarly named, but they are two different benefits. First, I will go over the new over 65 credit. Again, this benefit was previously a deduction. It was the over 65 deduction. It was changed to a credit during the most recent legislative session. It is now a credit of $150 that's applied against local property tax liability if, again, the applicant meets certain qualifications. Those qualifications include being 65 years of age or older by December 31st of the year before the credit is claimed. So if the credit is claimed for pay 2026, the person claiming the credit would need to be 65 by the end of 2025. The applicant for the credit also must own or be buying the property under contract for at least 1 year before claiming the credit. They also must own or be buying the property under contract on the date that they apply. And this benefit, this credit does still have an income threshold, although those amounts that previously applied to the deduction have been increased for this new over 65 credit. The income thresholds are $60,000 for an applicant who files their income taxes as a single individual. If the individual files their income taxes as a married couple filing jointly, the income limitation is $70,000. And if the applicant for this credit shares ownership of the property with others, there's an income threshold of $70,000 that applies to all of the owner's income. So they can't have a combined income of that exceeds $70,000. This credit statute also speaks to a surviving spouse that can be entitled to the credit under certain conditions. Those conditions are that the surviving spouse is at least 60 years or older by December 31st before the year the credit is claimed, so not 65, but 60 years or older. The surviving spouse's deceased husband or wife must have been at least 65 years old at the time of death, and the surviving spouse who is now seeking this credit must have not remarried. Obviously, this is meant to allow the surviving spouse of a deceased individual who would have otherwise qualified for the credit to get that credit, even if the spouse is not themselves over the age of 65. The over 65 credit statute also includes this interesting note about an individual who is away from the property in a nursing home or a hospital, and how that individual may not be denied the credit for being absent from the property while in those facilities. I say this is an interesting note because I'll mention it again in a few slides, but one of the differences between the over 65 deduction and this new over 65 credit is that there is no residency requirement for a property owner to receive this benefit. So it's interesting that they specified that the credit can't be denied while a property owner is away in a nursing home or hospital. Well, it's also true that there's no residency requirement in the statute. So this just makes it very explicit that property owners are able to still receive the benefit while in these medical facilities. I will also note here that if there are co-owners to the property that this credit would apply to, there is only one credit allowed. And in the case where there are multiple co-owners, but not all of them are over the age of 65, there is a reduction to the amount of the credit. And here on the next slide, we show you how that is calculated. As I mentioned previously, the credit amount is typically $150. Again, where there are co-owners to the property who are not all over the age of 65 years, the property or the credit is reduced proportionately by the number of co-owners who are not 65 years old. So you take 150, you multiply that by a fraction, which is the number of co-owners who are under 65 years old, divided by the total number of co-owners, and that's how you get your adjusted credit amount. Here we have spelled that example out more explicitly by taking an example where there are 3 co-owners to the property and only one of the co-owners is over 65 years old. The property otherwise qualifies for the credit, and so what you do is you take the number of co-owners under 65 divided by the number of total co-owners to get 0.667. You multiply that by the total credit amount and you get $100, and that's how much the credit must be reduced. So you take your $150 credit amount, you subtract $100, and you're left with $50 for the credit. So as I mentioned, there are differences between the over 65 deduction and this new over 65 credit. One of the big ones that we've had several questions on here at the department is about the residency requirement. The deduction did require that the individual and any co-owners reside on the property. The credit, the over 65 credit, does not include that same language, so there is no residency requirement for the credit. I mentioned also that the deduction did have income thresholds. Those have been increased for the credit, but there still are income limitations that apply to the credit. However, the amount of the threshold Under the deduction, those were adjusted annually by an amount equal to the Social Security cost of living adjustments. That Social Security cost of living adjustment calculation was not carried over to the over 65 credit for whatever reason. So that $60,000 threshold and $70,000 income threshold, those amounts, unless there's a change of law, will not be adjusted annually based on the Social Security COLAs. Another difference between the credit and the deduction, the credit has no limit on the assessed value of the property, whereas the deduction previously had a limit on the assessed value of $240,000. Again, similar to the blind and disabled credit, it's a credit and not a deduction, and therefore it's not subject to the limit on deductions for mobile and manufactured homes. Another change that we've received several questions on is what limitations, if any, apply to the over 65 credit that apply to the deduction. With the over 65 deduction, there was a limit in that statute that said that deduction couldn't be combined essentially with any other deductions except the homestead standard, the homestead supplemental, and the fertilizer storage deductions. The credit does not have that same limitation. There's no statutory limit on what this credit can be combined with, similar to the over 65 deduction. So I know folks had that in their minds a lot, and we've had several questions on that, but that limit was not carried over to the new credit. Moving on to the over 65 circuit breaker credit, which again is a similar title, but it's a different benefit. Its qualifications largely mirror the over 65 credit, except that there are no conditions on co-ownership or adjusting the amount of the credit based on co-owners. And a big distinction here is to qualify for the circuit breaker credit, the applicant must also qualify for the homestead deduction on the property in the previous year and in the current year. So as I mentioned, the over 65 credit has no residency requirement, but because the circuit breaker credit ties its qualification to the homestead deduction, that homestead deduction does have a residency requirement. To receive that benefit, an individual has to use the property as their principal place of residence. And so here you see slightly different qualifications for the over 65 credit versus the circuit breaker credit. Because of those differences, a taxpayer who is applying for these benefits must indicate on the application form which benefit they're applying to or applying for. It's one application, and you'll see at the top that there are check boxes that folks can indicate I'm applying for one or the other or both. They can apply for both if they qualify for both. So the circuit breaker credit amount is calculated as shown on the screen. The current year's tax liability, you subtract from that last year's tax liability multiplied by 1.02. And essentially that operates as a cap so that the growth in property taxes on the qualified homestead don't exceed 2% year over year. However, there is the ability to exceed that if it's based on improvements to or expansion of the homestead property after the assessment date for last year's taxes. So here we've got an example spelled out. You see a property tax liability of $1,000 for pay 2025 and $1,100 for pay 2026. Well, if you multiply last year's property tax liability of $1,000 times 1.02, you get the most that this property would be subject to, and that's $1,020. So you take that, you subtract it from what they would have paid, which is $1,100, and you're left with an $80 credit. The last deduction I will go over, last set of deductions, are deductions available to veterans, and there are three types that are still in code. There is a deduction for veterans with a service-connected disability, which is often called the partial deduction, although that might be a bit of a misnomer. This is a deduction based on a veteran's disability of at least 10% that's service-connected. So I've got the statute that falls under. The next one down, the totally disabled veteran or veteran at least 62 years old with a disability of 10% or more. I know a lot of folks often refer to that as the totally disabled veteran deduction. I would note that that deduction doesn't necessarily require a total disability. It can be a veteran who is at least 62 years old and is 10% or disabled or more. And then finally, there's a deduction for homesteads donated to a disabled veteran that we will cover. There was, prior to this year, still on the books, a deduction for surviving spouses of World War I veterans. I don't know how many folks were still receiving that benefit, but that has now expired and will be removed from statute. And still on the books and available are excise credits that apply or can apply when a veteran's property tax deductions cannot be fully utilized. And I'll mention that here shortly, but these are the statutes that apply to that benefit. So first, for the deduction available to veterans with a service-connected disability, the requirements for this benefit include serving in the U.S. military during any of its wars, being honorably discharged, and receiving a service-connected disability of 10% or more, as shown by the various documents from either the U.S. Department of Veterans Affairs that are listed or the Indiana Department of Veterans Affairs. This is a fixed amount deduction. The deduction amount is $24,960, and that amount, as I've alluded to previously, is subject to that limitation on personal property mobile homes. For the totally disabled veterans deduction or deduction for veterans age 62 with a disability equal to or greater than 10%, which is just rolls off the tongue. To qualify for that benefit, the applicant must have served in the U.S. military for at least 90 days. They must have been honorably discharged and received either a total disability, so 100% disability, or they must be at least 62 years old with a disability of 10% or more, again, as shown by documents from the U.S. Department of Veterans Affairs or the Indiana Department of Veterans Affairs. This is a slightly lower amount. It's $14,000, and again, this is subject to the limit on mobile home properties. For the non-service connected disability deduction, there is an AV limitation of $240,000. That limit doesn't apply to increases in assessed value due to trending unless the increase is attributable to substantial renovations or new improvements, and the county assessor is required to inform the auditor of any such improvements or renovations. Just a quick note that if a person qualifies for both of these deductions, they meet the separate requirements, they are allowed to receive both, and that total deduction amount is $38,960. There are allowances for surviving spouses that I will skip over because I want to make sure we have enough time. The deduction for a homestead donated to a veteran requires that a nonprofit organization donate a home to a veteran. And if that veteran is 50% or more disabled, the veteran receives a corresponding deduction from the assessed value based on their level of disability. So 50% disability would mean a 50% deduction. The veteran must have served in the U.S. military for at least 90 days and have been honorably discharged. And the disability here does not need to be service connected, and it can be shown by the same documents as for the totally disabled deduction. A person cannot receive this deduction for a homestead donated to a veteran along with either of the other two veterans deductions for the same assessment date. I mentioned that if not all of the deduction amount can be applied because the property value is too low, the balance of the veterans deductions can be used as a credit against the taxpayer's excise taxes, essentially at a rate of $2 for each $100 of assessed value from the deduction balance. And this is only available for the partially disabled and totally disabled deductions. And lastly, if the taxpayer does not own property to which these deductions can be applied, they can claim a credit against their vehicle excise tax, which can't exceed $70 and cannot be claimed on more than 2 vehicles that the taxpayer owns, and also can't be claimed along with the credit from the previous slide. And I've listed the statute that applies to this benefit. So with that, I will turn things over to my colleague, David Marusars.
Okay. Thank you, Stephen. We will go on to talk about the homestead deduction. For most homeowners, this will be the most significant deduction, at least in terms of dollar amount deducted from their assessed value. Just a first note, sometimes you might see this referred to as the standard deduction or the homestead standard. I may use those terms interchangeably with homestead deduction. Just be aware that I will be referring to the same deduction. Next slide. Before I go in talking about the deduction itself, I did want to point out that during the 2022 session, as Stephen mentioned earlier, the mortgage deduction was repealed, starting with taxes on page 24. So the value of the homestead deduction was increased by $3,000 to encompass the maximum deduction amount previously available for the mortgage deduction. And I will get into talking about the deduction amount for the homestead standard later on in this part of the presentation. Next. But before getting into that, I want to talk first about what the law says, or what the law contemplates when what is a homestead. The homestead deduction applies to the homestead, which is defined as the individual's dwelling used as a principal place of residence in the immediately surrounding 1 acre, even if that acre straddles multiple parcels. The dwelling is defined as the property used as the individual's residence, limited to a single house and a single attached or detached garage. Now, by principal place of residence, it's mentioned in statute, but it's not defined in statute. DLGF rules define this term as the individual's true, fixed, permanent home to which the individual intends to return after an absence. You might have referred to that sometimes as a domicile. It's essentially a common law principle that has been incorporated into a DLGF rules for purposes of defining principal place of residence. Now, in terms of qualifications, the applicant must own the homestead, be buying it under contract, or occupying it when the homestead is owned by a trust. On that last point, I will explain the details later on. Next. So in addition to a dwelling in the immediately surrounding 1 acre, a homestead may include any number of yard structures such as decks, patios, gazebos, or pools. An additional yard structure that doesn't include any of those I just mentioned, and one additional building that is predominantly used for a residential purpose and not used as investment or rental property. Next. So getting back into the amount of the standard deduction, for pay 26, the amount is $48,000. Like I said, with the mortgage deduction going away, starting with pay 24, the homestead deduction amount was originally $45,000, or the lesser of $45,000, or 60% of the gross AV. With the mortgage deduction, that $3,000 for which was the amount for that one was added to the homestead. So up until pay 26, the amount was the lesser of $48,000, or 60%. For pay 26, as a result of Senate Enrolled Act 1 from this past session, the amount of the deduction is $48,000. I want to make a few notes on this, however. First, this is a flat amount. That lesser of $48,000 or 60% that I just mentioned, that is no longer the case for pay 26. It is just a flat amount of $48,000. Also, as Stephen mentioned, for mobile and manufactured homes, the value of the property is limited to 1/2, or the value of the deduction rather is limited to half the property value. Lastly, since this is a flat amount, it will also be phased down over the next 5 years, so that by pay 2031, the value of the deduction is 0, as you will see on the next slide, how the phase-ins will occur. Now, you might wonder, I think it's very reasonable to wonder how There is still a standard deduction in pay 2031 when the value is zero. A taxpayer looking at their pay 31 bill may see that they have a deduction, but it's zero. It doesn't really reduce their AV any, and they might wonder how is that deducting? How is that a deduction? I'll have to first give kind of the stock answer of, well, it's what the law says. The amount of the deduction is zero, so that's what's applied. But I will add a couple additional considerations. One, when I get into talking about the supplemental deduction a little bit later on, this phase down is kind of tied into what happens with the supplemental. Effectively, by 2031, the supplemental deduction will become the new standard deduction. At least that's what appears the legislative intent is, to make the supplemental kind of the main source of relief for homesteads. And I'll get into that in a few slides. The second consideration is that one of the indirect benefits of receiving the homestead deduction is that a homestead will also be placed in the 1% property tax cap as opposed to the 2 or 3%. So receiving this, even though, again, eventually the value of the deduction will be zero on its face, the property will still be placed in that 1% bucket so that taxpayers' liability on the homestead would potentially not double or triple if they were placed in the other cap categories. So just those considerations to keep in mind. So next slide. Before going on to, I'll say a little bit more again about the supplemental in a bit, but first I want to go over some additional rules for getting the homestead standard deduction. So first, an individual or a married couple is entitled to only one homestead deduction for a particular year, with some exceptions. First exception, if the sole reason that the deduction is claimed on another property is that the individual or married couple maintained a principal residence at the other property on the assessment date in the same year in which the application is applied. You might think of this, in other words, as kind of the moving exception. If I owned a homestead, if I owned a property that I was using as my homestead for 1 year, and then later on in that year, I bought another house that I was moving into, and I was intending to use that as my principal place of residence as soon as I move in, I can apply for the homestead deduction on that second property that I just bought, even though I was already receiving the deduction on the previous property. It also does not matter if the second property had been newly purchased. Next slide. The second exception is for married couples. If one of the spouses lives in a different state, each spouse can claim a homestead deduction on their respective properties if the spouse living in Indiana affirms by affidavit the following. 1, each spouse maintains a separate principal place of residence. 2, neither spouse has an ownership interest in the other spouse's residence. And 3, neither spouse claimed a homestead deduction on another property other than their own residence. Next. So outside of this exception, a married couple who may be separated but not legally divorced may only receive one homestead deduction. Next. Now, with regard to the 1 acre limitation, the taxpayer can receive a complete deduction on the entire acre, even if it overlaps multiple parcels. Also, the deduction can be applied where the homestead is vacant or partially completed on the assessment date, and active duty service members can still claim a deduction even if on their homestead in Indiana, even if they are ordered to transfer to a location outside of the state. Next. Now there's kind of a specific rule with LLCs that's been in the homestead deduction statute for some time. In 2023, the legislature repealed the provision that allowed LLCs to receive the homestead deduction under a very specific circumstance. The following session in 24, the legislature put that back in. So what current law says, an LLC can receive a homestead deduction if the LLC owns the property, an individual occupying the homestead is a shareholder, partner, or member of the LLC, and the property, this is key, was eligible for the deduction, the homestead deduction on March 1st, 2009. If all those qualifications are met, the LLC can receive a homestead deduction. Next. Now for eligibility, we'll get into the next few slides, we'll cover eligibility and ineligibility. Um, uh, so the auditor may require an individual to prove eligibility and can limit that evidence to the state income tax return, a valid driver's license, or a valid voter registration card. A dispute over eligibility for deduction for 1 year does not necessarily justify requesting documentation for multiple years unless there is a basis for disputing it in all those years. Next. Likewise, an auditor should not tell taxpayers that the applicant must attach or provide with the application a Social Security card or tax return. The auditor cannot impose additional criteria or steps for applying. Moreover, and this is important, you cannot require submission of the entire Social Security number unless there is explicit legal authority to do so. And in a few slides, it'll say that you really, what must be provided are the last 5 digits of a Social Security number. That's all that needs to be provided. You cannot ask for the entire number. Next. We will now move, as I previewed earlier, talking about the supplemental deduction. This is automatically given to any taxpayer who receives the homestead deduction. It is applied against the net AV resulting after application of the homestead. In other words, say you have a property with a gross assessed value of a given amount, and for pay 26, the homestead deduction is applied on it, so the assessed value minus 48,000. The result of that is the amount against which the supplemental deduction is applied. So as with the homestead, there have been some recent changes to the amount of the deduction, the supplemental that is. It used to be that for a property with a net AV under 60 grand, the amount was 35% of the net AV. Again, the gross minus the amount of the homestead deduction. For a property over 60 grand, gross assessed value that is, the amount was 25%. The legislature over the last few sessions has adjusted the percentage as a means of providing tax relief. With Senate Enrolled Act 1, this amount has been set at 40% for pay 26. This amount will also be applied regardless of the net AV. You no longer really have to distinguish between whether the gross assessed value of a property was above and below $60,000. And like with the homestead deduction, this amount will be adjusted, but unlike with the homestead, whereas the homestead standard deduction is being phased out, the supplemental is being phased upward, let's say, over the next 5 years, as the next slide shows. These are the percentage amounts for the supplemental for the next 5 years. By pay 2031, the supplemental deduction will be essentially 2/3 of the gross AV of the property. So remember that the homestead deduction amount for pay 2031 is 0. So again, if you're subtracting gross AV by 0, you're going to end up with the gross AV. Just multiply that by 2/3, and that's the value of the supplemental deduction. There is a caveat with the supplemental, however. The deduction amount cannot be more than 75% of the gross AV of the property. So while you won't have to worry anymore about that $60,000 threshold, you will still have to worry about the 75% of the gross AV for purposes of applying the supplemental deduction. So that's that with the supplemental. Going on to the next slide. For filing, to claim the homestead deduction, there are 2 options. First, the HC-10 can be filed with the auditor in the county where the homestead is located. The HC-10 is a DLGF prescribed form. Alternatively, state law allows taxpayers to file a sales disclosure form as a means of applying for the homestead deduction. The slide shows the part of the sales disclosure form, or at least references or cites to the part of this form where you essentially just check off the box indicating that it's your intent that this is to be used to apply for the homestead deduction. As I mentioned earlier, the property must be receiving a homestead deduction to receive a 1% or be subject to the 1% property tax cap. Next. Excuse me. The deduction application must contain the last 5 digits of the applicant and their spouse's social security number. Now, if either does not have a social security number, it can be substituted by the individual's driver's license number, state ID number, or tax ID number obtained through the Internal Revenue Service. Now, if none of these are available, a control number that is on a document issued to the individual by the federal government can be used. Next slide. Now, if a person changes the use of the homestead or obtains another homestead deduction or equivalent on another property so that it no longer qualifies for the homestead deduction, the person must file the certified statement with the county auditor to that effect. A person who fails to file a statement may be liable under a separate statute for back taxes that would have been due if the statement had been filed timely and the deduction removed. And the next slide discusses describes the statute for the auditor making a determination about a property being ineligible for the homestead deduction and being able to collect back taxes. I'll move on, please, to the next slide after this one. Thank you. Which basically just summarizes what was 2 slides before. Auditors have discretion to seek taxes and liabilities or penalties corresponding to an ineligible homestead deduction. If an auditor chooses to seek back taxes and penalties, they can only go back 3 years. And the auditor must notify the owner of the taxes, interest, and penalties due and direct payments to be made to the county auditor. Now, there will be a lien placed on the property for the back taxes and penalties. However, if you go to the previous slide, there is a protection for a purchaser, a bona fide purchaser of the homestead, who did not have knowledge of the auditor's determination that the property was ineligible. In that case, no lien will attach for any additional taxes and civil penalties that result from the removal of the deduction. So move on to the next slide. So we will now briefly talk about eligibility of trusts for deductions. By law, trusts may receive a homestead and supplemental, as well as a veteran's deduction under conditions specified on the next slide. So to receive a deduction, the trust-owned property must be occupied by an individual who is either a beneficiary to the trust or has a right to occupy rent-free under the terms of a qualified personal residence trust created by the U.S. Treasury regulations. The individual must also qualify for the deduction being claimed, except of course for the ownership part, because the trust is the one that owns the property. Next. So we discussed homestead. We're now going to discuss the heritage barns deduction. This one is fairly fact sensitive and very definition heavy. So I'll just quickly go over what we're talking about here with heritage barns. First, a barn, for the purposes of this deduction, is defined as a building, not a dwelling, that was designed for agricultural purposes, for the essentially any agricultural purpose. Next slide. Now, a heritage barn is a mortise and tenon barn constructed before 1950 and retains sufficient integrity of design, materials, and construction to clearly identify the building as a barn. Next slide. Excuse me. So we have a barn and a heritage barn, but now we have a mortise and tenon barn. It's a barn that was built using heavy wooden timbers joined together with a wood-pegged mortise and tenon joinery that form an exposed structural frame. Excuse me, an exposed structural frame. So in other words, when we're talking about a heritage barn, we're talking about a barn designed to be used for an agricultural purpose, built prior to 1950, and using a specific construction method. Like I said, it's a very fact-sensitive situation. But we're not done with definitions. Next slide. Statute for the deduction also defines an eligible applicant, essentially anyone who owns a heritage barn as defined, or is buying one under contract that meets certain qualifications. Like the qualifications for somebody buying a homestead under contract. There's similar qualifications. Next slide. So the amount of the Heritage Barn deduction is $0, 100%. Mixing my deductions up. 0% of the AV of the structure and foundation of the Heritage Barn. Now, for applying, this application must be filed before the year in which the deduction will be applied. Now, this is different than the other deductions, which by law can be filed to up to January 15 of the year the taxes are due. So like with the homestead deduction, if somebody wants to file for the pay 26 taxes, they have to file like the HE10 by January 15 of 2026. If the taxpayer likewise wants to file for the Heritage Barn deduction, they have until December 31st of 25. So want to bring up that difference. The deduction does terminate following a change in ownership of the Heritage Barn, but it does not terminate if just one of the joint owners of the property or purchasers of the property under contract have been removed. Next slide. Now, even with the deduction, the county council may adopt an ordinance to require a person receiving the deduction to pay an annual public safety fee for each Heritage Barn for which the person receives the deduction, up to $50. The auditor must distribute public safety fees equitably among police and fire departments serving the area where the barn is located, and the DLGF must also receive a copy of the ordinance imposing the fee. Next. So to apply, the taxpayer must complete the appropriate form. Link is on the slide, and file it with the county auditor's office again by the end of the year for next year's taxes. So next year, when the next year's the pay year. So that takes care of the Heritage Barn. We'll now I will close in the next couple of minutes discussing new deduction and credits that have been created by Senate Enrolled Act 1. First, there's a new deduction for properties that are subject to the 2% property tax cap. This includes non-homestead residentials, long-term care properties, and farmland. This deduction is automatically applied. The auditor must identify eligible properties and apply the deduction. So the amount of the deduction, as we saw with the homestead supplemental, is phased in over several years so that by 2031, the amount is 1/3 of the gross AV of the property within the 2% property tax cap. There's also a supplemental credit next, starting in pay 26 for persons who qualify for the homestead deduction or a surviving spouse of a person who qualified at the time of death. This credit is also automatically applied. The auditor has to identify eligible properties and apply the credit, which is the amount of which is $300, the lesser of $300, or 10% of that year's tax liability. So we'll close by having briefly just reminding that there have been some deductions that have expiring by Senate Enrolled Act 1. Stephen mentioned some of these previously. The list is on the following slide. As these are being sunset, the DLGF has been working to rescind and remove the relevant application forms for these deductions. And that takes care of the substantive portion. I will turn it back over to Stephen to close us out.
Thank you, Dave. I appreciate it. And thank you, everyone who's attended. If you have questions, I see we are right up against our time. So I'm sure Jenny will have some instructions about submitting any remaining questions in the Q&A box, but also I wanted to display our contact information here. Certainly, we will take all the questions that you've submitted in the chat function or the Q&A function, compile those, and as Jenny mentioned, I believe the plan is to release a Q&A or an FAQ document to address those. But into the future, if you have additional questions, don't hesitate to reach out and contact us. We're here to help, and we appreciate everyone attending today.
Thank you, Stephen and Dave. I appreciate everyone that joined us today for the webinar. As I mentioned before the webinar, this PowerPoint, video, CE form, and the survey will be emailed out to those that pre-registered. This is all self-reporting if you are wanting CE credit, so you will need to fill out the form and then submit that to the appropriate place. If you are needing CLE credit for our attorneys, you will need to fill out the survey and put your attorney number at the end, and then we will get that filed for you. And please stay tuned for our November and December webinars. We hope that you will join us at one of those. We are planning for 2026. So if you have any suggested topics that you would like to see us cover, please feel free to email them to me, or you can fill those out on the survey and put that feedback in there. And as we start to plan for 2026, hopefully we'll be able to provide some new webinar topics that are relevant and current for you. So again, thank you for joining us today, and we hopefully will see you in November at our November webinar.